Welcome back, everyone, to the 9th Annual Laurentian Bank Institutional Investor Conference Series. My name is Naman Sati. I'm the Diversified Industries Analyst here at Laurentian Bank. For this session as well, Jordan Simon will be helping me in the background to moderate this session. Just some housekeeping items before we start. Please ensure your microphone is on mute and your camera is turned off during the presentation. Please ensure that your name appears on screen so we can promptly address any questions that you have. We will try to take some questions and answers at the end of this session, but please feel free to write any questions in the chat session. Jordan will be monitoring them and we can sort of pick them and ask them to our panelists. We have a very exciting name with us, Boyd Group Services, Inc. I think Boyd is extremely well known, especially among the Canadian investors community. It's really a success story for Canada. I'll still introduce them a little bit. That the Boyd Group is one of the largest operators of non-franchised collision repair centers in North America in terms of number of locations and sales. And most of you would know that M&A has been one of their growth driver, and they've become quite big that way. From Boyd, we have Mr. Tim O'Day, who's the President and Chief Executive Officer. He's been with the firm since 1998, and he had a long career with Boyd, and he's been in this current role since January 2017. And we also have with us Mr. Pat, who joined Boyd Group in January 2015 as Executive Vice President and Chief Financial Officer. He brings with him a 30 years experience within finance, strategy, corporate development, and operations of Boyd. So these are probably the two best people within the firm and within the industry to get a sense of what's going on. So welcome, Tim. Welcome, Pat. I really appreciate you guys taking out time to speak with our investor community and sharing your thoughts with everyone. Thank you.
Yeah, thanks for having us.
Thank you.
Yes. Yeah. So I'll just start with something that's it's very topical. Probably you guys hear it every day. All investors ask you, and I'll repeat myself again, which is what's happening on the supply chain side? How bad is it? How good is it?
Well, we started to experience some supply chain challenges actually in the second quarter of last year. And when we reported Q2, we noted it, but it wasn't all that significant at that time, although it did accelerate during Q3. And we found that more parts were unavailable, both OE parts and alternative parts, particularly aftermarket parts. And those were largely related to the overall supply chain challenges. On the aftermarket side, most of those parts are manufactured in Asia and then imported into the US. So there are a number of problems from manufacturing capacity to labor availability to the supply chain challenges that get in that product to the shores of the US and then distributed throughout the country. So it was growingly impactful in Q3, and really, while we haven't provided any updated guidance since we reported Q3, we did note that for Q4 we didn't really expect things to normalize or to improve during that quarter.
Okay, but at the start of this year, have things started to gradually, sequentially improve, or is it still the same way last year?
We haven't provided any updates since mid-November, but when we reported in mid-November, which really wasn't that long ago, we'd not yet seen improvement.
Okay, that's fair. And generally, not speaking about what's happening currently, but over the last 2 years, a lot of things have changed. Since the start of this pandemic, has there something that has secularly changed within your business? And if you've adapted something new within your practices?
I'd say the one change that's impacted the industry, and it was actually occurring before the pandemic, but carriers were moving to processing and settling more claims by way of photo versus having an adjuster physically at the vehicle to assess the damage. So that was growing fairly rapidly. The pandemic accelerated that. And because for the most part, carriers pulled their field staff and tried to move everything to photo settlement or direct repair. So there has been a trend that has been ongoing. I'd say it's stabilized now. It's not, haven't seen it grow more recently, but more than 20% of claims are being settled by photo now. Carriers do not use that method of settlement when they have a client that is looking to get their vehicle repaired, because it ends up putting their customer through more work. An initial estimate be a photo, then it has to be reconciled when it gets to one of their direct repair shops. And it also increases the risk that they won't refer that customer through their direct repair network for the repair, which is important to them. So I would say that's been one significant trend that has accelerated during the pandemic. And it's impacted our business as well. During the pandemic, in order to reduce customer contact, we did start writing more estimates via photo. We had the ability for customers to drop off a vehicle and not interact with one of our team members. When they dropped it off, we do it more by phone and emailing estimates. So that's a change that will remain in place if it's convenient for the customer, even post the pandemic. And finally, like most businesses, I think we've learned that many of the things that we needed to do face to face over the years, not all, but many of those things can be done virtually. So even, for example, much of the integration work that we do now has been moved to virtual meetings versus live meetings. Not all of it, but I think we've learned to be a little bit more efficient because of the challenges we've gone through over the past couple of years.
Yeah, no wonder we're doing this conference virtual as well. So,
right.
So surely it has changed. But when you talk about some of these claims getting from picture, that means that more businesses will flow through the direct repair programs, which should bode well for you then.
Yeah, I think the photo settlement is really the least costly way for an insurance company to settle a claim with a policyholder who doesn't have an intent to repair. If they have an intent to repair, they're better off routing them through their direct repair programs because it has higher levels of customer satisfaction and really is a low-cost option for the carrier as well. And the lack of field staff just pushed more of the volume to photo settlement.
Oh, okay, that's great. The second point, I think that's also very topical, is the labor challenges. I know it's been exacerbated recently, but these issues were creeping up prior to COVID-19 as well. You have implemented some programs to sort of mitigate that, but is there anything else that you can do, or is there something that's being done, or is it largely dependent on the macro environment factors? If they improve, you benefit from it. And maybe I'll just add on to it that when you announced your last results, I remember you said that you could have serviced more business if there was more labor availability. So how's that looking? Has that changed a bit?
Yeah, we did report that our backlogs had grown pretty meaningfully, and that's we prefer not to have that. But the labor challenges in our industry have been going on for a number of years. We've commented on pretty frequently over the past probably 3 or 4 years, although they've been spotty and not as chronic. So it's certainly a bigger challenge today than it was. And some of that is the macro environment that we just have to deal with. But we have a number of initiatives underway to mitigate the impact of this. For example, in order to improve retention, we proactively looked at our workforce and made sure that we were competitive in our rates to our team members so that they wouldn't seek out other employment opportunities in a highly competitive market. So we were proactive on that. We've implemented for new hires a formal onboarding program. And really the retention in the first year is a pretty critical issue. And the better we get with onboarding and making people feel included and part of our company, the more effective we'll be on the retention side. Along those same lines, we've been delivering training to our frontline leadership to improve their ability to lead and manage their teams. I think a lot of the research suggests that the reason people leave organizations is often because of their leader. So we're investing in more leadership training to try and address that issue. And we're very focused on creating an inclusive environment, which has a couple of benefits. Not only will it help with retention, but we're also looking for employees in different places, trying to become more diverse, and it requires being inclusive in order for that strategy to be successful.
Oh, okay, that's great. But you've been working with Void you have a long history with them. I'm just wondering, the supply chain, or sorry, the labor challenges that the industry is seeing, are they in any way different than what you saw previously, or is it the same and eventually it sort of evens out, or how is this different than what you had before?
Well, as I said a couple minutes ago, we've always had some labor challenges. but they've been spotty and not necessarily broad-based. And what the industry is experiencing today is broad-based, at least in the US market. So we have a labor shortage of specifically primarily the technical talent, the body technicians, that's broad-based for our industry. Just as a couple of data points to put some color around that, there's an organization that operates in both Canada and the US and a few other countries called ICAR, and they administer a program they call Gold Class, which is if you're a Gold Class shop, which Boyd is committed to Gold Class, you have trained your staff up to an industry standard that is generally expected to participate in direct repair programs and some OE certification programs. As part of the Gold Class program, ICAR actually gets a census of the industry's workforce at the time of renewal. And in the most recent rounds of renewals, ICAR has reported that there are about 15% fewer people in the collision repair Gold Class shops than there were prior to the pandemic. So that would suggest that the industry workforce is down pretty meaningfully as a result of what we've gone through in the pandemic. Further support of that, looking at it from the other angle, is that there was a survey done by a collision industry publication last fall, and 81% of the respondents to the survey said they were looking for a body technician, and almost half of those said they were looking for 2 or more body technicians. So this is different from what we've experienced before.
And Norman, just to supplement, this is not unique to our collision industry. Every single industry is experiencing a similar shortage of talent. And in fact, if you look at broadly in the US, the labor participation rate is around 62% compared to 67% 20 years ago. So this is unprecedented in terms of what we are going through.
Okay, no, that's really good data points out there. But internally, you monitor it through retention ratios. Like, how does that work, and is that improving, or how do you sort of keep track of that?
Yeah, we don't disclose those numbers, although we have seen improvement in our retention rates over the past few years. And I would say much of that is coming, despite the fact that it's a highly competitive market. I think we've enhanced our HR-related programs, things like onboarding, retention initiatives, more training and engagement, and we're going to continue to do that. We also are a leader in the industry in terms of developing our people with training. We're the only company in North America that has a large dedicated team of technical trainers. They train on the ICAR curriculum, which is the industry standard. And so our trainers would actually get to know our team members. We're not relying on outside trainers to deliver the vast majority of the training that we do in our company. We also have a program that we're pretty proud of called our Apprenticeship Development Program, or our Technician Development Program, which is an apprenticeship program that we started back in 2018. And we saw the need to develop our own talent even prior to that. The program, unfortunately, we suspended it during the pandemic because it does have a fair amount of cost associated with it. But at the beginning of last year, we restarted it, really built the program up during 2021. We're very pleased with the results, and we've recently communicated that it's our intent to more than double the size of that program. And over time, at scale and maturity, we would expect that program to generate a fairly good percentage of our technician needs as we continue to grow our business.
You know, that's wonderful, color. And just with these pressures, there's also like increasing wage pressure. So how much of the cost increase can you actually pass on to the clients, and what sort of discussions you're having with insurance companies with regards to pricing? And are those adjustments on an yearly basis, or I'm assuming there would be some sort of inflation component baked into it. So how's that looking like? Yeah,
typically there's not an inflation component built into it, but as the market moves, the insurers have moved up. So if you look at our history and look back at our margins over the past 10 years, really up until the pandemic, and you'll see that our margins have been very stable. They actually improved a little bit during the pandemic, but they've been very stable. And that's because as we've experienced wage pressure over the years, we've been able to recover that wage pressure from our clients, not necessarily in lockstep. Sometimes we may go a little ahead of it. Sometimes we may be a little bit behind it, and it moves market by market. So on a blended basis, we've had very stable margins. Unfortunately, what happened really beginning late Q2 and then starting more aggressively in Q3 was the volume of repair work for the industry recovered substantially. The industry is understaffed to serve a normal level of volume, and that increased really the competition for skilled labor, and it drove wages up to both recruit and retain that labor. And insurance clients just aren't set up to move rapidly, and because we don't have clear pricing power, we have to negotiate and make our case to them to increase rates. But as we said when we reported in November, we're in discussions with all of our clients, and those discussions have been very positive, although it may take time to fully recover, given the significance of the increases.
Okay, that's fair. I think we have some questions in the chat. Jordan, do you mind asking those questions, please?
Sure. We have a question from the audience. How many trainees go through the technician development program each year? Is that number increasing each year? They're just trying to get a sense for how material this program could be for relieving the shortage.
We don't disclose the actual numbers, although as we grow it, and we've been growing it throughout 2021 with a plan to grow it significantly more over the next 6 quarters. At that time, it should be at a mature level, and it should, at a mature level, satisfy a significant percentage of our technician needs going forward. So this is not a small program. It's a fairly major investment for us, and quite honestly, we need the industry to step up and do this more broadly. Some of our competitors are doing this, but Boyd alone won't solve the industry problem. It's really going to take a concerted effort by many players in the industry to solve the labor shortage.
Okay, no, that's good. Is there another question, Jordan?
We have, one more question. Given the labor challenges and to a less degree supply chain challenges for the industry, are you able to capitalize on your M&A strategy?
Pat, I'll let you handle that one.
No, yeah, exactly. I think our M&A pipeline is looking good. And we provided guidance to double our revenues by 2025 using 2019 as the base. And we feel pretty good and pretty confident about that guidance. And again, we don't want to comment on the short term, but if you look at what happened in 2021, we added 127 locations. So that's a record additions. So we feel good about our M&A program.
Okay, that's good. And just staying on that M&A theme, if you could just tell how the environment has changed over the 18 months. Have the valuation multiples gone up? How's that environment looking like?
Yeah, the valuation multiples for single shops have not changed much. We typically underwrite single shops to 25% pre-tax ROIC. And for MSOs, we do not disclose the multiples for competitive reasons. So however, we can provide some color. The multiples we paid for the 2 large MSOs, namely John Harris and Collision Works, are lower than what we paid for Assured back in 2017. So to jog your memory, we paid 9.6 times EBITDA for Assured in July 2017.
Okay, that's fair. And since now your size is a little big, has it changed that your focus is on multi-store locations, or you're still going after the single ones? Like, what's the thought process that way?
No, we have a multi-pronged strategy. So certainly now we are pursuing the single shops because 57% of the revenues are contributed by the single shops in the industry. We also pursue the MSOs. And also we have increased our focus on the brownfield greenfields. In addition, we are dialing up with the same store sales growth. So those are the various arrows in our quiver to accomplish our growth goal.
Okay, no, that's wonderful. And just I'll stay on this thing since we're talking of M&A. When I look at your locations in terms of geography, are there any states that you see have more potential where you can expand more? Because in some states you have quite a bit of presence, but in some there is still some room. So how is that sort of strategy coming along?
No, yeah, we do have both the strategic perspective as well as we are opportunistic in terms of pursuing these acquisitions. So again, we don't disclose our target markets for competitive reasons. But yeah, we are in right now 31 states, and there is no reason for us not to move into all 50 states down the road.
Okay. And has due diligence become a more difficult thing to do in this environment where you really cannot fully figure what's the normalized potential of a business is in this environment? So how does that impact your due diligence process?
In fact, we have a fairly streamlined due diligence process, and early on, we were very concerned about sending teams on-site for due diligence, and we developed a hybrid model to do virtual due diligence, and now we have supplemented with the actual physical due diligence on-site. So yeah, we have a process that is working very well. So we are not concerned about the due diligence process at all.
Okay, so there is a dedicated team that just focuses on that part of it.
Yeah, absolutely. Yeah, if you look at our team, so we have the team that focuses on the sourcing the deals, the business development team, and then we have a team that does the diligence, and also we have a team that negotiates the deal and closes the deal, and then we have a post-close integration team. So we have a pretty streamlined playbook.
Okay, that's good. And just for the benefit of audience, generally, how long is this process? What's like when you have the first touch point with one of these shops, and how long does it take to eventually roll them under your banner?
Again, it varies. So we have deals that we consummated very quickly, and there are deals that have taken for a very long time. For example, Assured, it took almost 10 years to nurture the relationship and to get the deal done. So we cannot just give a simple answer. So it widely varies. It varies from situation to situation. But if a company is going through a formal auction process, then it's fairly quick because they're in a hurry to get the deal done. In some cases, you have to be patient and pursue them.
Yeah, and it varies for like, do you have internal targets in terms of synergies as well? Like, do you target 18 months, 24 months that by this period, a new location should have some sort of synergies that should start coming in, or how do you think about that?
No, and again, the synergies, it varies. The industry, you may have a single shops that may not have any DRP programs at all. Then we can bring those DRP programs. And similarly, in terms of the cost of sales, we bring our purchasing power. We get the volume discounts or economies of scale and things like that. And we put the hub and spoke because of our presence in the particular market in terms of the load balancing. So we can, if a shop doesn't have sufficient volume, we can move from other locations. So yeah, it varies from shop to shop, but we do bring a lot of synergies to the table when we acquire. But again, it varies both in terms of the percentage of synergies as well as the duration to realize those synergies.
But I think on the long end, we would expect synergies to have been achieved within 3 years.
Okay, no, that's
some
fair.
could be much quicker, particularly single shop operations.
Okay, no, that's fair. And just changing gears a little bit here, I've noticed that if we exclude the COVID period, you've been growing faster than the industry. Your same-store sales, excluding this COVID period, for 5-6 years, has been close to 4.5%, and you've benefited from price increases as well. I'm just wondering if there are some other elements that have helped you grow faster than the industry, and if your DRP relationships with the insurance companies, how that have evolved over the years, and specifically in the last 12 to 18 months.
Absolutely. Yes, the DRP programs have been a significant contributor to our same-store sales growth. So these programs have grown over the past several years because they deliver a better solution for the vehicle owner and the insurer. So insurance companies are becoming more performance-oriented and are increasing focus on the average cost of repair, customer satisfaction, cycle time measured as length of rental, and quality. So we've been making great progress on these areas and provide great value to insurance companies and customers. Because of that, we're gaining market share.
Okay, fair enough. And the new bill that comes out, which sort of gives consumer more options when they sort of deal with these insurance companies, how does that impact your business? Like, does it make it easier, or will consumer go to like shops of their preference, or like insurance company will still be able to guide their decision making?
I mean, for insurance claims, the consumer always has the choice of where to repair their vehicle. So that's a right that the consumer has, insurers work with direct repair programs to create a pretty frictionless environment for a customer to get their car repaired. And there's some added value to the vehicle owner for following or for having their repair done in a direct repair shop. For example, we would warrant the repairs that we do for the life of the vehicle after the repair is completed, but the insurers also warrant that. And for a small player in the industry that may not be around, that could be a real value to the consumer. But more importantly, in a direct repair program, once we get a vehicle, we can move right to repairing it as quickly as possible, keeping the customer up to date and trying to keep the cost as low as we can for the customer and the insurance carrier. We don't have to call for approval if we find an additional part or labor operations that's needed. So once we get the vehicle in, we can move through the repair very quickly. And that results in a higher level of satisfaction and a lower cost for the repair. So there's a pretty significant benefit to both the insurer and the vehicle owner to choosing direct repair.
Yeah, just to supplement, I think some people may have a misconception about the DRPs. So they're not directing you have to get this done. They refer the customers to us. So it's a referral program because in several states, they have the anti-steering laws. So they can't mandate you have to get it done at Gerber or Boyd. So we get the work because of the value we deliver, able to do things faster, cheaper, and better.
Okay, no, that's wonderful color. I think we have a question from audience. Jordan, do you want to ask that, please?
Yes, we have. What catalyst should we be watching for to change the investor sentiment on the stock? Is your opinion, what is the market missing?
Well, I think that the market is just concerned on the length of time it'll take to recover our labor margins. The supply chain disruption obviously is impacting our profitability today. So we have three challenges: supply chain disruption and the labor shortage and the wage pressure. So we've talked about the programs that we've got in place to improve retention and drive building, the team members that we need to service the available business. That will take time, but we're very confident in our long-term prospects around that. The rapid escalation of wages and the need for insurance clients to up their reimbursement rates to cover that will take some time, but we have a long history of margin stability. And the insurance carriers need a healthy collision repair industry, because if we can't service our customers, they're going to lose policyholders, because when they have a claim, they're counting on their insurance company to guide them through it and solve the problem. And if they can't do that because they've underfunded the collision repair industry, it's really going to be very bad for their policyholder retention. And the supply chain disruption, we don't know when that's going to end, but the supply chain disruption will be reduced over time. And as that's reduced, we should see our part margins return to normal levels. And I believe that we've got upside as we leverage new systems and technologies to improve our part margins further.
If people take a very short-term view, then we cannot tell what's going to happen in the next quarter, if we're going to solve all these problems or not. But if you look at the broad investment thesis for a reasonable time frame, it's intact. The industry is still highly fragmented. We can be a great consolidator and derive tremendous synergies and enhance our shareholders' value. So that's why we provided a long-term guidance, and we're very confident of accomplishing that.
And maybe just to add on to that, to provide a little bit more color around it, because of the way that we're built with a network of shops, kind of a concentrated network of shops, we have the ability to manage repairs on a hub and spoke basis. For example, if we were to take in a Tesla at a store, but that isn't a Tesla certified store, we can move it to a Tesla certified store. If we have a vehicle with structural aluminum damage, which requires an investment of about $100,000 plus training to be prepared to repair those vehicles, we don't have to repair it in a center that doesn't have the right equipment or training. We can move it. So we're able to leverage our investment and better serve our customers. And as vehicle repairs increase in complexity, we're going to continue to build out that hub and spoke capability to address emerging needs effectively with better returns than the 57% of the industry that's a single shop environment.
Okay, no, that's great color. Just the two challenges that you've mentioned, one is the supply chain and the labor one. which one would you think is going to stay for longer, and which one do you think is more takes up more of your attention, let's say, than the other one?
Well, the labor takes more of our attention than the supply chain challenges, and well, we don't know when the supply chain challenges will be mitigated. And your guess on it is as good as mine. But from what we're reading, I would say that there's a chance that we'll see some improvement in that in the second half of this year, and probably more substantial recovery in 2023. But we are taking actions today to mitigate the impact of the supply chain challenges. Working with suppliers to identify where parts might be in the network, trying to get more parts through our primary suppliers, negotiating more favorable discounts where we think we have market leverage to do that. So we're acting on those things now, and would expect that we can see some improvement, even absent the improvement in the supply chain. The labor shortage is one that we're investing heavily in, both on the recruitment side, the retention side, and the building of people side. But that's not a quick fix. So we were fighting the labor battle before the pandemic, and we're fighting it today. But I would say we have more weapons deployed to it today, and we're moving very aggressively.
Okay, that's fair. And how much of a role automation can play in it, or is that difficult to do?
I think the automation of the repair opportunities are somewhat limited, because every single job that we do is relatively unique. No repair is identical to the next repair. But there may be some labor segmentation opportunities, and there are likely some technology opportunities to help us better operate and make our shops more efficient using data. And so we've got initiatives underway to better understand the data so that we can guide our locations to become more efficient, and that should improve our capacity.
And also, I think that there is a room for automation in the corporate service and strategic support services. And we have a program right now we're implementing. So that should enhance the productivity in those areas meaningfully.
Okay, that's fair. And I think you have this WOW operating way as well. So is that something which is a dynamic program, or is it like you continue to improve it and then implement it across all your network, or how does that work?
Yeah, the WOW operating way is really our standard set of operating procedures for how we want. Initially, it was really how we wanted our shops to run, from scheduling and work to understanding our capacity, to what we do as soon as a vehicle arrives, how we manage it through production, how we deliver a quality repair. And so it's a repeatable standard set of trainable processes with measurements where we can see whether those processes are being effectively deployed and managed. The spirit of the WOW operating way, and really the spirit of our business, is to find continuous ways to refine and improve it. So we introduced the WOW operating way back in, I think, 2014 or 15, and we've been consistently looking at opportunities to refine and improve it over the years. Pat just mentioned that most recently, we've extended the WOW operating way out to our strategic support services, HR, finance, and procurement. So we have more standard operating procedures there that will ultimately benefit our stores and make our stores more efficient. So it's a dynamic program that we invest in every year.
Okay, no, that's good color. And just, I think there's one more question from the audience. Jordan, do you want to ask that, please?
Sure. I think as the world gets more automated, you have lots of automobiles coming out with full self-driving capabilities. How do you see that impacting your business, given that collisions and accidents on a standardized basis seems to be a lot lower in an ideal full self-driving world?
Yeah, that's a very common question that we get. And in our investor deck, we actually have a slide that comes from CCC Intelligent Solutions, which is the largest claim processor in the United States. And they have looked at the adoption of ADAS in the vehicle fleet and its impact on claim frequency per mile driven over about the next 30 years. And based on that data, we are expecting claim frequency per mile driven to decline by 1 to 1.5% annually Gradually in the coming years, it'll decelerate a little bit toward the latter part of that. But there are a few critical offsets to that that are important for investors to understand. One is that the data that's presented is claim frequency per mile driven. And in the US and in North America, miles driven has been increasing steadily for many, many years. Now, the pandemic did disrupt that, but I think the expectation is that miles driven will continue to increase by about 1% annually going forward. In addition to that, the same thing that's reducing the mile or reducing accident frequency per mile driven is driving up repair costs. So the ADAS systems have to be repaired when a vehicle is damaged. And there are new operations, both more expensive parts and then new operations typically related to calibrating and making sure that ADAS sensor is pointed the right direction or working properly so that the vehicle is safe. And that's driving the average cost of repair up at faster than the core rate of inflation. In addition, there's a fundamental shift in the vehicle mix going on. Most new vehicles sold today are not sedans, whereas years ago that would have been the case. It's mostly crossovers and SUVs and trucks. And those have a higher average cost of repair, which creates some additional growth in the dollar size of the collision repair market. And then lastly, the increasing complexity of the vehicles and our ability to establish and use our network to have centers of excellence around certain types of repairs will allow us to take in repairs of all types, get them to the right location, invest in the training and the equipment, and be able to get good returns on that equipment across our network rather than shop by shop. And we believe that that will drive and accelerate the pace of consolidation.
I think those are very fair points. Jordan, is there any other question? I think we're getting close to the end of the time. If there is one, you can ask.
No question. No more.
No question. No, I would I would just like to thank both Tim and Pat. I really appreciate it. I know it's a challenging environment. There's a lot of things that are happening on the macro environment, and you have to sort of navigate a lot of these things on a daily basis. So thanks for sharing your perspective, not just in the near term, but some of the points that you highlighted, how the market is adapting to some of these secular shifts from technology and how that sort of impacts your business. So I really appreciate your time. Once again, I would really like to thank you for your time and for your presence in our conference. And for our audience, I'd just like to point out that 11:30 we'll have a next session with CargoJet. So once again, Tim, Pat, I really appreciate your time and thanks for sharing your thoughts. Thank you.
Thank you. Appreciate it.
Thanks, Norman, and thanks everyone. Have a great day.